You're watching the market right here in ET Now with me, Aisha Faridi, Avan Dabash, Nikunj Dalmia on the show, and the chop and churn for the market continues. No different this morning as well, or for that matter, how we shut shop in trade yesterday. That's exactly the nifty picture for you, and yes, those jagged edges are right. But let's tell you what happened overnight. The fact that inflation has actually cooled off for the US equity markets. Remember, yesterday they had their inflation print, and that's bringing about some amount of cheer, at least for the markets, or at least anticipation that Fed may not be as aggressive with their rate hikes. And yes, you did see some amount of cheer for US equity markets. They ended in the green, and the Nasdaq managed to extend its gain for a second consecutive, or rather fifth consecutive session. But that said, for our markets, that disconnect, Nikunj, clearly continues. We're just not following it up from global
No,
cues.
it's not, the start for 2023 is not on expected or not on anticipated lines. After so many months of outperformance, suddenly when you are on the other side of the equation, which is underperformance, you got to ask yourself why. Why were we doing so brilliantly well in 2022, and
what
why are
has
we
changed?
exactly? So what has changed? Well, the calendar year has changed, but apart from that, the positioning of the macro is changing. High inflation is speaking out, and markets are now looking, global money allocators are now looking at alternates. So Indian markets may have got outflows, but other markets are getting inflows. India has always competed with other emerging markets like Taiwan, China, Brazil, and those markets are getting inflows, and Indian markets are getting outflows because the positioning of the equity market, at least the initial trends are indicating that it is changing, and it wants to really reorient itself given where the macro positioning of the world is. That's the sum and summary of the Thursday's price action. Nasdaq, it extended gain for the fifth session. For Indian markets, the volatility is still very high, and inflation cool off has managed to cheer Wall Street. We are just not acting, reacting, acknowledging, or even mapping what the global setup is.
Yeah, speaking of the global setup, you did have the Dow Jones, the Nasdaq, as well as the S&P 500, which in their regular trading session managed to end up in the green. They actually headed for a winning week for the week gone by, with the Nasdaq and the S&P 500 on pace for their best weekly performance since November. Yes, you did have the CPI report showing that prices declined about 0.1% over November. Prices rose at a 6.5% pace compared to the previous year, and that really heightens hopes for the Federal Reserve to perhaps slow its hiking of interest rates. Asian markets as well this morning seem to be mirroring that, with a smart gain, and the SGX Nifty absolutely flat at around 17,900 thereabouts. But let's take you through the outlook as to what our markets did, and just put the details into perspective. We've declined for 6 out of the last 7 trading sessions. FIIs have been selling every day since the start of this year, and have sold accumulatively close to 14,996 odd crores this month. We've seen mild unwinding on the Nifty on the F&O side, and short covering as well on the Nifty Bank Index. And, Nikunj, if we were to look at it from sort of a technical parlance, 17,800, is this going to act as a super support for the Nifty?
Yeah, I was looking for that word, and we got in the morning when we were making the graphics, super support. Why is 17,800 acting as a super support? Well, a lot now hinges in the short term in terms of where the market wants to move. So far, the bulls have done a great job of defending 17,800, or let's say 14,200 on a closing basis. So the bulls are delighted that support is holding on. But the bears also know that minute you go below 17,800, which in a sense has been this super support or Lakshman Rekha, then in the near term, the market will see a sizable downside. The macros are not that great in terms of where the flows are moving. The earning season is off to an okay start, and if that support is taken out, whether it's on an intraday basis or whether it is on a closing basis, then in the short term, immediate amount of downside would be opened. So for a trader, it becomes a difficult market to call. We have been of the view that Nifty is in a no trade zone, the bank Nifty is in a no trade zone. You should not try and attempt trading right now till the time you don't get clarity. Either this market has to decisively go above, which means that the bulls are back, or the market will break down below those key levels, which will acknowledge and which in a sense would be an endorsement of the fact that bears this time have arrived and they are here to stay. So it's one of those phases of the market, trust me, when you're better off not trading or taking a short-term view on benchmark indices.
Okay, well, the focus this morning, of course, is going to be the IT names. Remember, now you've got Infosys as well as HCL Technologies both in the bag, and good performance there. And I think the question now comes, Nikunj, whether TCS and Infy managed to bridge the gap further or not, like we were discussing yesterday.
So, Aisha, these numbers in a sense clearly indicate that the worst of the downgrade cycle is behind. So, from a stock standpoint in terms of the earning compression, or also in terms of where the stock compression would happen, the downside I think will get limited and restricted. Then second, you look at the medium term outlook. The medium term outlook by most of the IT companies is that things are looking up. They will not they will not drop from where they are. Then we look at the three companies which have come out with numbers. If I have to look at the three companies which have come out with numbers, in my book, I think Infosys is the one which stands out. They've increased their guidance. The stock is available at a discount to TCS. The trajectory of Infosys in terms of what it has done, I think looks decent to me. But HCL Tech has managed to beat the estimates, but that's largely because in middle of the quarter they came out and they downgraded their numbers. So the estimate bar was also low, and HCL Tech still has to get their mojo back in terms of getting the margins really to industry average. So for me, Infosys becomes more like a trade or more like a stock where there is a hope, and the premium what TCS has enjoyed because of comfort, because of sheer growth, I think should narrow down. TCS Infosys will not give you a forward-looking guidance for FY24, but the fact that they've had a big quarter of deal win and 8 quarters, this is the biggest deal win in last 8 quarters, that just gives you some kind of an acknowledgement that things are moving up and attrition is coming down. So the way I look at IT is that the downgrade cycle is behind us, upgrade cycle is yet to start. In the near term, because Nasdaq is looking up, global technology stocks are coming back, a sharpish bounce in some of the technology stocks cannot be ruled out, but it would be a bounce, 2 to 3%, 4 to 5%, because everybody is on the same side of the boat, everybody is universally bearish on IT, so bounce cannot be ruled out. But I don't think market will start, we are not in for a structural decline, we are not in for a structural uptick. Like in banks, you are in for a structural uptick. Metals, you are in for a structural decline. IT, the structural decline is behind us, but the structural uptick is yet to start. I'm not hedging myself. It's something which I see happening.
Yeah, just to put it into perspective, by the way, Infosys has increased its FY23 guidance to now 16 to 16.5% from the earlier 15 to 16% on the back of strong revenue beat that they saw in the third quarter of FY23. The constant currency revenue growth came in at about 2.4% versus the anticipated 1.2%. So yes, those numbers would be looked at strong given the current dynamic. In fact, overnight as well, you had the ADR shoot up about 1%. Let's see what the market reacts to once the markets open this morning. And the PAT as well has been a beat. It's come in at 6,586 crore rupees. That's managed to beat the estimates of 6550 odd crore rupees. Additionally, large deal TCV for the quarter was the strongest that they've had in the last 8 quarters. But let's hear out what the managements of both Infosys as well as HCL Technologies had to say after they reported their numbers.
In terms of what we see in the environment, we are not commenting obviously on the financial year 24 and what the guidance or growth in that year will look like. What we do see in terms of demand environment is what I shared earlier. We see some areas, for example, the mortgages area or the investment banking area and financial services. We see some areas in telco and high tech and some in retail. There is more variation. We see in the European markets more concerns on what's going on with the economy. The US market is also there, but relatively less so in the US with respect to Europe. We will see how this plays out because this is not a scenario where it's the same for every industry. For example, we've seen extremely strong growth in energy, utilities, that part of our business, and we continue to see that in Q3. We saw very strong growth in manufacturing, and we continue to see some of that traction in our business in Q3.
Business as well as our HCL software business. Our services business grew 15.4% year on year and 2.2% sequentially in constant currency. We posted an improved EBIT of 19.6%, driven by improvements in our services business and a huge uptick coming in from the seasonal gains that we have in the software business. Overall, we are continuing to see a good demand environment, especially deals which are IT operating model changes is a very important theme, and we are seeing significant traction there. Cloud adoption is another theme on which we are seeing some good traction. And the third element is vendor consolidation. We see there is a significant amount of opportunities and wins that we've had on the vendor consolidation. So vendor consolidation, cost optimization, and integrated opportunities.
All right, that's a summary of the big IT earnings. And of course, today we'll be watching out closely for what Wipro delivers in their Q3 report card. But moving right on, let's hear it out from Samir Arora, fund manager at Helios Capital. He says that in the financial space, they're holding on to the large cap names like HDFC Bank, ICICI Bank, and SBI.
Have HDFC Bank, ICICI Bank, and State Bank in nearly the same weight. Actually, technically, right now, HDFC Bank may not even be first. It might have become second. But broadly, they're all 7.5%. And we also own Axis Bank, and we also own IDFC First Bank. So the thing is, we don't own the other state-owned banks because generally we have been uncomfortable all our life with those stocks. And just because they became cheap for a trade, maybe we should have bought it for that trade. But I still don't believe that these companies have got that much freedom. Okay, we can say that they are at a point where NPAs have been written off and all that. But generally, we have been for 25 years done well betting against all these things. So by moving towards it would have been a very big change in our mind, and we were not ready and are not ready to do that. But clearly, we have a reasonable bet in financials relative to, say, tech. So that is how the financial became so overweight, because we took the view that whatever may happen in IT, it will mostly underperform our market, which it seems to have done, although we didn't get it right. I mean, we didn't sell them all at the top. But from Jan last year, I've been saying, and we reduced some in Jan, but the rest only in July or August. In IT, I mean. And that money was transferred to financials and consumer.